Strategy is now paying out roughly $730 million a year just on Stretch, or STRC, preferred dividends, and that represents only a single layer of obligations sitting on top of a Bitcoin treasury worth approximately $58.5 billion. And billions more in additional preferred stock commitments, over $8 billion in convertible debt, and a software business that by management's own financial disclosures cannot cover the bills. And it all starts to give off a House of Cards sort of vibe. The entire machine functions as long as Bitcoin keeps appreciating and the capital markets keep absorbing new share issuances. But if either condition fails, the consequences would extend far beyond a single company's balance sheet and threaten to destabilize the broader crypto market itself. So today, we'll explain how strategy actually works under the hood, what has to go right for it to survive, and what happens to Bitcoin if it unwinds. My name is DC, and you're watching The Coin Bureau. Back before Michael Saylor got totally orange-pilled and became, in effect, Bitcoin's final boss, his company, then called MicroStrategy, was a pretty successful software business. Its enterprise analytics software has never exactly set pulses racing, but then it wasn't really designed to. Even now that the company has rebranded to Strategy and became famous for holding ungodly amounts of Bitcoin, that software continues to generate approximately $477 million per year in revenue. But the boring old software business produces roughly $328 million in gross profit against $576 million in selling, general and administrative expenses, meaning the core operating business loses somewhere between $80 million and $120 million annually before you even consider a single Bitcoin-related obligation. This means that the software division, the company's only revenue-generating operation, cannot cover its own overhead, let alone service this massive capital structure built on top of it. No, the real engine powering Strategy is a perpetual capital cycle that works like this. The company files automatic shelf registration statements under Rule 415 of the Securities Act, authorizing what are known as at-the-market or ATM equity offerings. Through omnibus sales agreements with banks, including TD Securities, Barclays, and Cantor Fitzgerald, Strategy continuously sells newly created shares directly into the open market at prevailing prices. The proceeds are immediately deployed into Bitcoin purchases. Management then points to the growing Bitcoin balance sheet to sustain investor confidence and maintain the stock's premium over its net asset value. That elevated premium then allows the company to issue even more equity, purchasing even more Bitcoin per unit of dilution created. This is what Strategy calls Bitcoin yield, and it is the entire thesis. In fiscal year 2025 alone, this ATM program raised approximately $15.2 billion in equity while expanding the weighted average share count by 52.7%, from roughly 192 million shares to 294 million. Furthermore, the total shares outstanding had reached approximately 326 million by March 2026, confirming that the issuance machine has continued accelerating into the current year. Now, here is where the logic becomes dangerously reflexive. This cycle is accretive to existing shareholders only when the stock trades at a premium to the per-share value of its Bitcoin holdings. So when MSTR commanded a 2 to 3 times premium to its net asset value in early 2025, every new share sold effectively purchased double the Bitcoin that $1 of underlying value would suggest. But in late 2025, MSTR briefly traded at a discount to its market-implied net asset value, or NAV, for the first time since January 2024, hitting approximately 0.85 times its Bitcoin backing. At that point, the flywheel reserves direction entirely, and every new share sold destroys value for existing holders rather than creating it. And by the way, tracking these news events before they affect your portfolio is exactly why you need the Coin Bureau Telegram channel. It's where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates regarding these global regulatory shifts. So make sure you secure your informational advantage today by clicking the link in the description below or by scanning the QR code currently displayed on your screen. Okay, back to the strategy. Now, you might assume that a company holding nearly 781,000 Bitcoin with a stock price reflecting that massive treasury would possess a relatively straightforward balance sheet. That assumption, though, completely ignores the extraordinary tower of financial obligations that has been stacked on top of these coins. Each layer demanding payment before the common shareholder sees a single dollar of residual value. At the very top sit approximately $8.28 billion in convertible senior notes, carrying a blended interest rate of just 0.42%, with maturities staggered from 2027 through 2031. These notes are unsecured with no direct Bitcoin collateral requirement, but they absolutely must be satisfied first in any liquidation scenario. Now, below the debt sit multiple layers of preferred stock, each with its own dividend obligation. STRF or Strife pays a fixed 10% annual dividend. Stretch or STRC, the variable rate perpetual preferred, currently pays 11.5% annualized and carries a market cap of approximately $27.8 billion. Strike or STRK pays an 8% annual dividend that can critically be settled in common MSTR shares rather than cash, creating yet another dilution vector. And lastly, Stride, STRD, pays a non-cumulative 10% fixed dividend, sitting junior to everything above it. Beneath all these layers, absorbing every dollar of residual volatility, sits the common equity with a beta of approximately 3.4 times relative to Bitcoin. Strategy describes its own leverage through what it calls the amplification ratio, which measures total senior claims against net asset value. The ratio currently stands at roughly 33%, meaning senior obligations now consume 1/3 of the entire Bitcoin treasury's value before common shareholders receive anything. This creates a structural condition where a 1/3 decline in Bitcoin from current levels would theoretically eliminate the entire buffer protecting common equity holders. Now, the critical question becomes whether the underlying mathematics of this structure can actually sustain itself. And the numbers reveal just how narrow the margin of survival truly is. Strategy's total annual cash obligations across preferred dividends and convertible note interest currently approach $1.12 billion per year. The software business contributes effectively zero net dollars towards servicing that figure. Michael Saylor has publicly stated that the company requires only a 2.05% annual appreciation in Bitcoin to cover these obligations indefinitely. The arithmetic appears defensible on the surface. 2.05% of roughly 58.5 billion in Bitcoin holdings equals approximately 1.2 billion, which theoretically covers the annual burden. But this calculation contains a fundamental flaw that Saylor's public framing consistently obscures. Unrealized gains on a balance sheet cannot pay cash dividends, so stretch holders receive monthly cash payments funded not by Bitcoin appreciation, but by the continuous issuance of new equity and preferred stock through the ATM programs. If those programs stall because the NAV premium collapses or market appetite evaporates, the mechanism for funding these dividends breaks entirely. The company maintains a USD reserve of approximately $1.4 to $2.25 billion, depending on the reporting period, providing a runway of roughly 15 to 30 months before obligations would overwhelm available cash. And Bitcoin's actual performance in the first quarter of 2026 delivered a 22.6% decline, generating $14.46 billion in unrealized generally accepted accounting principles, or GAAP losses, and pushing the company's aggregate cost basis of approximately $75,577 per coin above the prevailing market price. Furthermore, approximately $1 billion in convertible notes include put options, allowing holders to demand cash repayment at par around September 2027. So if the MSTR stock price sits below the conversion threshold of roughly $183 at that date, note holders have absolutely no incentive to convert into equity and will demand their money back in cash. This September 2027 deadline represents the most concrete near-term solvency pressure point in the entire capital structure. You see, this is precisely why the aggressive promotion of Stretch deserves particular scrutiny. Both Saylor and CEO Fong Lei have characterized Stretch as the company's iPhone moment, a revolutionary product that broadens the investor base into what they describe as low volatility, high yield digital credit. Saylor has compared Stretch to a bank that pays you 20% interest and has specifically recommended it for family treasuries, explicitly targeting individuals and families seeking conservative income. The company markets Stretch to investors who typically park capital in money market funds but are seeking high returns. This framing is extraordinarily misleading, though, when you examine what Stretch holders actually own. Stretch is a perpetual preferred stock with no maturity date, no guaranteed path to principal repayment outside the secondary market, and no collateral backing from the Bitcoin Treasury. It is legally classified as equity, not debt, which means Strategy cannot technically default on it in the bankruptcy triggering sense. Dividends are payable only when declared by the board of directors out of legally available funds. The reported stability, near $100 par, is not a product of genuine creditworthiness, but is manufactured through continuous rate manipulation. The dividend started at approximately 9% at launch in mid-2025 and has been raised at least 7 consecutive times to reach the current 11.5%, demonstrating that the company had to keep sweetening the terms to prevent the price from collapsing below par. Roughly 80% of Stretch holders are retail investors compared to the approximately 40% retail ownership of the common stock. And these are precisely the income-seeking conservative investors who are least equipped to absorb the downside risk embedded in this instrument. At 11.5%, Stretch yields approximately 450 basis points above junk-rated corporate bonds. From an issuer carrying a Piotrowski F score of just 2 out of 9 and an Altman Z score sitting at 1.98, squarely in the gray zone that indicates elevated bankruptcy risk. The reality is that many of these retail holders are running leveraged carry trades without fully understanding that they sit subordinate to over $8 billion in convertible debt that must be satisfied before they see any recovery in a liquidation. But even if Strategy never sells a single Bitcoin, the accounting framework now governing its financial statements has created its own independent mechanism for triggering a confidence spiral. FASB Accounting Standards Update 2023-08 became effective for Strategy beginning January 2025, requiring all Bitcoin holdings to be marked to a fair value every single quarter, with unrealized gains and losses flowing directly through the income statement. In the fourth quarter of 2025, Strategy reported a $17.4 billion operating loss driven entirely by this mark-to-market treatment. And in the first quarter of 2026, the company recorded $14.46 billion in additional unrealized losses on digital assets. These are non-cash charges that do not represent actual money leaving the company, but they appear on the GAAP income statement as catastrophic financial results, and the downstream consequences of those headlines are devastatingly real. This creates a reflexive feedback loop that operates with mechanical precision. Bitcoin fails, generating massive reported accounting losses. MSTR stock declines at 3.4 times the rate of Bitcoin's decline due to its amplified beta. The NAV premium compresses, making ATM equity issuance dilutive rather than accretive. Investors lose confidence in the equity story, reducing demand for new Stretch issuances. The company is then forced to raise the Stretch dividend rate to maintain the par anchor, which increases future obligations, which further deteriorates the credit profile, which reinforces the entire downward cycle. Strategy's CEO, Phong Le, has characterized these as GAAP losses, not cash losses, and emphasized that the company maintains a fortress balance sheet. But a $14.46 billion quarterly loss headline does not require a margin call to inflict severe damage on market confidence. And market confidence is the singular resource this structure cannot survive without. Now consider what happens to the broader cryptocurrency market if Strategy is ever forced to liquidate even a fraction of its holdings. Strategy holds 780,897 Bitcoin as of April 2026, representing approximately 3.9% of the entire circulating supply. The company will probably have stacked even more sats by the time you see this video. So at current prices, this position exceeds a full day of global Bitcoin trading volume, which Saylor himself has cited at roughly $50 billion a day. Selling even 10% of that stack, approximately 78,000 coins, worth nearly $5.9 billion, would represent almost 12% of daily market volume, an order of magnitude that would move prices significantly and immediately. Strategy's depth is unsecured, meaning there are no automatic price triggers that force immediate Bitcoin sales. But the triggers for forced unwind are structural rather than contractual. Inability to refinance convertible notes at the 2027 maturity, inability to raise capital through ATM programs for an extended period while owning cumulative preferred dividends, or a governance failure at the board level. If forced selling began, the announcement alone would trigger aggressive front-running across Bitcoin markets. Large block selling would cascade through crypto-native lenders facing their own collateral calls. Bitcoin ETFs experiencing redemption pressure as retail sentiment collapses, other corporate Bitcoin Treasury holders like Marathon Digital and Riot platforms whose balance sheets carry similar Bitcoin dependencies, and the massive leveraged derivatives market where a single day in late 2025 already produced $19 billion in liquidations from excessive positioning. In March 2026, Strategy absorbed 44,377 of the 47,435 Bitcoin added to all corporate treasuries combined, representing 93.6% of total corporate accumulation. So if the single largest non-ETF buyer of Bitcoin transforms into the single largest seller of Bitcoin, the impact on order books and market psychology would be unprecedented and not pretty to watch. Now, Strategy is not fraudulent, and calling it a Ponzi scheme misidentifies the nature of the risk. The underlying asset is real, the disclosures are public, and the structure is legal under current securities law. But it shares one structural characteristic with every leveraged scheme that has ever collapsed. It requires a constant inflow of new capital to service existing obligations, and it depends entirely on a single asset appreciating at a rate that exceeds the cost of the capital structure built on top of it. Bitcoin has historically delivered the growth rates that make this arithmetic work over multi-year periods, and that is the honest bull case. But the people purchasing Stretch at 11.5% because Michael Saylor compared it to a high-yield bank account deserve to understand exactly what they are holding. A perpetual, non-collateralized, subordinated equity instrument whose dividend is funded by diluting the shareholders beneath them, issued by a company whose core business loses money in a structure that has never been tested through a prolonged Bitcoin bear market. The numbers are entirely public, and the math either works or it doesn't. Let's hope we don't find out what happens in that latter scenario. So will Bitcoin's long-term trajectory validate the most aggressive single-asset leverage bet in corporate history, or has Strategy constructed a house of cards that eventually collapses on its own weight? Please share your analysis in the comments below, because the outcome of this particular experiment affects every single participant in the crypto market. And if you want to understand how accounting changes are reshaping institutional Bitcoin adoption beyond Strategy, you should check out our dedicated analysis right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC signing off.